I'm Dominic. I'm a PhD candidate at Harvard. This is a project on revenue-based financing. This is joint work with Claire and Rowan, who are also PhD candidates here. Very sorry we couldn't be there in person, but we're really excited to be included in this agenda, and we are very excited to learn more from our discussants. We already enjoyed the conversation we've had with them, and we're excited to learn from all of you in the room. So at a high level, we're motivated by the emergence of these fintech-provided revenue-based financing contracts around the world. These are often provided by companies that play some role in payment processing. So in the US, there's companies like Square and Stripe and Toast offering these products. But we're increasingly seeing them in emerging and developing markets as well. Companies like Ant Financial in China, Velocity in India, and the context that we're going to study is in South Africa, but there's a number of other contexts around the world in which we're seeing this. The actual structure of the contract is going to vary quite a bit between different contexts, but they generally involve some degree of repayment flexibility that comes from tying the size of repayments to revenue. So here's a couple of examples of advertisements from Square and Toast, and you can see Toast prominently advertising that repayment is going to flex with your restaurant's daily sales. If the sales go up, your repayments are going to be higher. If your sales go down, your repayments are going to be lower. And so in the paper, we have a sort of economic motivation for studying this, which I think is very in line with the spirit of this conference. You can imagine if you're a food truck owner in South Africa and you're thinking about expanding to a second food truck, you might know that in expectation that investment is going to do well, but there's some risk with taking out capital to make that investment in a second food truck. And your livelihood comes from the first one, so you might not want to do anything to sort of jeopardize that. In perfect financial markets, there's an easy solution to this. You write a state contingent contract with risk-neutral financiers. You say, if the second food truck works out, you pay me back a lot. If it doesn't work out, you pay me back less or nothing at all. But doing this at scale, I think as folks have been talking about, it's hindered by a number of different frictions. I'm sure like in that example, we can all come up with a number of different problems that might arise doing that sort of contracting. And there's a long line of literature and economics studying that. And so we want to think about today and in this project is how these new revenue-based financing contracts and digital payments and financial technology more broadly interact with this trade-off between information and incentive frictions on the one hand and insurance and flexibility on the other hand. I think that's come up time and time again already at this conference. And so this talk is going to provide some evidence and lessons that we learned in one particular setting on this trade-off. Okay, so as I mentioned, our setting is in South Africa. We have data from one of the largest South African financial technology companies. They're primarily a payment processor. They process about $2 billion in transactions per year, and they're used by over 250,000 South African small and medium-sized businesses. In addition to offering this payment processing product, they offer a capital advance product, which is a form of this revenue-based financing. So businesses will pay back some principal plus a fee with some share of their processed transactions. On the next slide, I'll walk you through an example of exactly how that would work. They've issued about 37,000 of these advances and readvances from 2018 to 2023. And one thing I want to point out in this context, which again varies between different contexts, here there's no floor on payments or personal guarantee. So you have substantial risk sharing even on the extensive margin. If your business fails, then you'll owe nothing at all. And that's going to sort of shape this insurance and flexibility trade-off with information and incentive frictions. Okay, so just to make concrete what one of these advances look like in our setting, you can think about it, an average business, which has about $6,000 in sales over the last 3 months. The average principal of an advance is going to be about 1 month's worth of revenue, so about $2,000. And the amount due is going to be that principal plus some fixed fee. And so they're going to owe $2,600. That's going to stay fixed, and they're going to repay that with some fixed amount of their daily revenue each day that's processed through this payment processor. So 20% is the average we see in the data. And if sales stay constant, the duration of this financing will be 6.5 months. But if sales increase, the duration will be shorter. And if sales decrease, the duration will be longer. So what's staying fixed is the total amount due and the total share of your payments that are going each day to repay that total amount. but the duration is changing, and so the effective APR is changing. If your sales fall, the effective APR falls. If your sales increase, the effective APR increases. And so that's a sense in which there is flexibility in the setting. Okay, and so a natural place that we wanted to start when we were working on this project, we wanted to think about how advanced takers' revenue perform compared to similar non-takers. But one thing before actually the result, one thing important to note is that we don't have random assignment in this context. We're not running an RCT like some of these other papers. So this comparison between businesses who take advances and businesses who don't take advances is not going to be a causal effect. And in fact, this is what we see. So in the green line here in the left panel, that's the revenue of businesses that take advances. You can see it's sort of increasing for the 3 months before they take an advance and then decreasing over the next 8 months. And we can match them based on the observables that we see and that the payment processor can see. And you see that the businesses in the orange line, which is this match control, looks similar over the 3 months before they take an advance and then diverges in the months after these other businesses take an advance. The right panel is just plotting estimates of that gap. And so you can see in about 8 months after these businesses take an advance, their revenue is 15% lower than comparable non-takers. And so we can do this in a panel regression. We can do this using machine learning techniques where we try to just use all of the observables available again to us in the payment processor, and we get very similar estimates. And so it's consistent with this idea that advanced takers might be different than non-takers in some way, sort of a story of adverse selection. It's also consistent with the idea that these advanced takers are doing things to hide revenue and slow repayment and lower their effective APR on their financing. And so in the paper, what we do is we try to sort of measure these different forces and think about the ways in which they contribute to this gap that we see here. For this talk, I figured one thing that would be helpful is to just sort of structure our findings and the rest of the paper around 3 lessons that I think we learned that were helpful for us and hopefully will be at least somewhat helpful to practitioners in the room. Okay, so the first lesson, which is sort of follows maybe naturally from that result, is that these financial technology revenue-based financing contracts are sort of not immune from classic information problems in economics. We find evidence of adverse selection that businesses with lower revenues, at least in the short run, seem more likely to take advances. We try to estimate the extent to which that gap is driven by adverse selection in a natural experiment, and we estimate it's around sort of 60% of that gap. And this adverse selection is not necessarily nefarious. So I think folks already have talked about cases in which businesses are using financing for seasonality, and that's a sort of reason to have these flexible repayments. That sort of thing can drive the adverse selection that we're seeing in the data, that sort of seasonality. And there's a number of sort of less nefarious things where you sort of need capital to overcome periods where you have lower revenue. That can drive the adverse selection that we see. We also find evidence of this hiding that I mentioned, that businesses do hide revenue to lower their effective APR. We use a competitor payment processor cutting their prices in a particular area. We show that after that other payment processor is more cheap to acquire, it's more cheap to sort of move some of your payments over to this other payment processor, advanced performance seems to decrease, consistent with, again, businesses taking out another processor to slow the rate of repayment. And so one thing I want to note is this problem is tied sort of inherently to the performance contingent nature of the contract. Again, the sort of flexibility that we like and the insurance that we like is creating this information and incentive problem. And so it's sort of a dual-edged sword in that way, and something that RBF financiers need to manage. The one bright spot I'll point out is when we present this paper to pure rational economic audiences, one thing they'll say is like, oh, there's no personal guarantee. Why is not everyone just like running away, all the time? It's crazy that gap is not, much bigger. And so we do an exercise in the paper to think about, how this compares to a rational benchmark. And it seems like businesses really value this sort of continued relationship with the platform, or there's some other forces, morality or something sort of keeping businesses from hiding more. And so that's sort of a bright spot in this analysis. And another bright spot here in our second lesson is about how financial technology and contract design can help mitigate some of these challenges. So 3 sort of sub-lessons of that. First, we show that the payment processors collect a lot of additional information. Here, they have different inventory management systems that run through this processor, different accounting systems, and so all of that information can be useful for predicting future repayment. So the one example we use in the paper is that there's this manage button you can click, and you can use that to sort of manage your inventory and have that tied to your payment processing. And that significantly predicts business performance. And that could be both because it's mitigating adverse selection. It's telling you about the sort of quality of the business. They're doing things to sort of actively manage their inventory. But it can also be because if you have this sort of automatic tie between payment processing and your inventory, getting another payment processor and sort of running things through that is going to mess up all of that. And so we call it sort of sticky features, where it's sort of painful for you to do things to hide because it's going to mess up other things that you're using. And so from a purely practitioner perspective, I think it's less clear. It's important, which of those two things is driving it, but you can still use all of this non-lending data that these platforms create, and you can use it to predict advanced performance. The second thing, which again has come up a couple times today, is this idea that repeat interactions and the repeated interactions that these platforms have can improve repayment. So we have a natural experiment where the business is waiting 6 months to give advances instead of 3. That seems to increase performance of this capital. We also show that repeat advances perform much better than first time. And so people have mentioned this sort of, you develop a relationship by lending, it's sort of learning by lending. And we show that seems to be a force in this setting. And some of these payment processors and fintech providers, have sort of these long relationships with these different merchants, and they can sort of use that to their advantage. I'll skip quickly through 3 because we don't talk about it too much in the paper. But the contract itself can be used to sort of manage this trade-off again between frictions and flexibility. Not having a sort of floor on repayments is something that is different between this context and the US, for example, where you usually have that. And so you can use that contract to strike the balance between flexibility and hiding. And again, that's a point that I think has come up repeatedly throughout the day. Okay, and then the last lesson, which I think is again another sort of a bright spot, is it does seem like this contract has positive causal effects on businesses. So one thing we can do in the paper is we try to estimate this adverse selection and the moral hazard, and then we can decompose that gap I showed you on the first slide. We show that adverse selection and moral hazard sort of more than explain the gap, and so anything anything additional to the gap is a positive causal effect. And so with some reasonable estimates, we think we get a causal effect of about 8% increase in revenue over the next 3 months. One other more sort of direct thing we can do to estimate this is we can just look at whether businesses are expanding their footprint. So if you think of the food truck example I gave you before, you can imagine that this food truck expands to, is in one city and expands to a second food truck in a second city. And even if they're hiding some of their transactions by using another payment processor, I can still see as a payment processor that they used to have one location and now they have 2 locations. And so that's evidence of expansion. And so we try to use that to see if we can see some evidence that people are using this capital to expand their businesses. And we do see that that's the case. Okay, so just to conclude and turn it over to our discussants, this revenue-based financing contracts, as this conference is talking about, provides this theoretical risk-sharing benefit that could be beneficial to providing incentives for entrepreneurs to invest. And our results are suggestive that there are these sort of positive causal effects. But at the same time, this flexibility, introduces and amplifies different asymmetric information challenges. Digital payment platforms might be well suited to help mitigate some of these challenges. I talked about the different features and how that sort of creates stickiness that makes it costly for businesses to hide transactions. They also have a rich data on payment history. Other features, like other sort of aspects of their platform, might give them rich data to make these predictions, and that can reduce hidden information as well. So overall, we think this is a sort of promising way to bring some of these flexible financing ideas to scale for very small businesses. And we think there's lots more to be done. So we're very excited about this space. And with that, I'll turn it over to our discussants. Thanks for the time.
Thank you very much, Dominic. So we're very lucky to be joined by Damilola from Moniepoint and Jonathan from Recap, but I'm going to leave it to you both to tell the audience a bit about who you are, what you do, and the businesses you work for. So Damilola, should we start with you?
Yes, that's fine. So my name is Damilola. I currently work in the product development department at Moniepoint. Moniepoint is it's a fintech, a business bank at the same time. Essentially, we provide banking services to both businesses and consumers. And I work in the lending arm of the bank itself. So essentially, what we've done is we've built a system that can, try and figure out what to give people based on what they turn over. So you try and, evaluate what it is the business does within Moniepoint itself, right? And try to, lend to them based on that. Now, in the product we've built, we have tried to, we have done some things that are extremely interesting with respect to what I've seen in this paper. So going through the paper, I saw a lot of, similarities between what they are talking about and what we actually experience in the industry. And how so? So an example is the stickiness he mentioned. Essentially, we are offering a lending product, but we can only offer to customers as much as Moniepoint can give us. So we can lend to customers, based on the kinds of customers that Moniepoint already has. And the reason we want to do that is, first off, we can give money to people we want to give money to people based on what we know about them. That's with respect to what is their payment history like, how do they behave, what's their behavior outside of, what we've lent to them or what we want to lend to them first. And we also want to lend to people based on the fact that eventually we want to get our money back, right? So we want to lend to them in a way that we can get our money back. So essentially we lend to them based on, how much business are you doing with Moniepoint as a bank, and how much of the money we give you can we take back, right? I think I'll hand over to you from that.
Thank you, Damilola.
Yeah.
So I'm Jonathan Field. I'm the Managing Director of Recap, which is a UK-based revenue finance business. And many of you will be asking why I'm here if we're based in the UK. Well, one of our founding shareholders is Retail Capital, which is a South African revenue-based finance business, which has worked with many of the payment processors in the South African market. So what Dominic and his co-authors found certainly resonates with me, and I found it's a very interesting reading. So thank you, Dominic, for sharing that. I think I'll start by touching on this issue of moral hazard and revenue hiding. So it's practically something that we see both in our UK business as well as my ex-colleagues in South Africa. They're also facing this challenge. And to use an example, just the other day, I walked down the road to my local barber to have a haircut in central London. And when presented with the option to pay for the haircut, obviously we here in London, most of the payment methods are card-based. There's very little cash in this economy. There were 3 different point-of-sale provider options that I could pay with or pay on. And therein lies the very point, which is, as a financier to these POS-based companies, you face the risk that the merchant or the taker accepts the funding and then shifts the revenue to another platform. And we're seeing it. And I have the fortune of having the unique perspective of having operated in the South African business for 2 years, and then I came across here about 18 months ago. And we've seen it both in South Africa and in the UK market. The South African market, albeit sub-Saharan Africa, is a lot more like a developed market than one likes to admit. There are quite a few similarities between the business in South Africa and the UK, and we are practical discussants. So I think it would be worth speaking to some of the solutions or mitigations that we employ to mitigate the impact of this revenue hiding behavior. So first and foremost, one of the things that the paper maybe doesn't specifically mention is the alternative forms of repayment in the form of a direct debit. In South Africa, they refer to it as a debit order. Effectively, as the lender, you have a mandate on that business bank account to pull a payment from the account in the event that the repayments through the card machine or the online terminal are unsuccessful. So that is certainly one solution. That being said, sometimes if the merchant truly intends to not repay, you might find that not only are they using a new card machine, but they're also using a new bank account. That's I think, one of the stark differences between the UK and the South African market is this increased optionality here in the UK market. There must be upwards of 25 retail point of sale companies that I could rattle off right now offering this solution to merchants in the UK. South Africa, there's less optionality. The same goes for bank accounts. If I'm using a Tide account today, I could probably open a Monzo account like this. It's not quite as easy in South Africa. Speaking of banks and bank technology, open banking technology is something that we've put to good use in this market. Our colleagues in South Africa don't quite have the same luxury, but it's a preventative or a proactive way of mitigating this revenue shifting risk. And what I mean by that is, just in a sort of a 30-second summary of how open banking works for the uninitiated, is a merchant consents or grants us permission to get read-only access to their business bank account, so we can look as far back as 3 years, as well as get the next 90 days of transaction or bank account data coming into our CRM. And what that allows us to do is to detect the presence of multiple PSPs, payment service providers. And in so doing, we can say, hold on, maybe there is an increased risk here of revenue shifting. And then just to conclude on the solution side before handing back to Paddy or Damilola, is arguably the best way to solve for this is an alignment of incentives with the PSP and working with the PSP, and that can be achieved in one or two ways. The most obvious is that in a revenue-based finance model, the PSP and the lender often into a revenue sharing model, which means that you're sharing at the top line as the PSP, so your incentive is to deliver a deal and then move on to the next one. If you enter into an economic sharing model, an unincorporated joint venture, and you share at the bottom line, and you make the PSP accountable for the bottom line returns, and they're now sharing in your risk, they are more incentivized to assist you in chasing up on bad performers and bad players, as well as to not funnel you customers who are potentially or more likely to not pay. So I'll stop there and maybe come back to Dami or to Paddy.
I forgot to check my phone whether we've got anything online. So can we look around in the room? Do we have some questions? Who's got the mic? And there's a couple right over on this side, Stephen. Nothing online yet.
So my question is to Jonathan. In the presentation, I think we talked about this before. Let's say the company takes 10% of the revenue to pay back the loan. How do you determine that this is the right amount to make sure that the business is still sustainable? Because still the business needs the money to buy back inventory, do whatever. How to make sure you're getting the best amount that gets your money back as soon as you can, but still not hurting the business?
So it's a brilliant question. So part of our underwriting model is to consider affordability and affordability within sectors. So what we look at is we look at the different sectors of the SME economy, and we make assumptions around the margin or the gross margin in that particular sector, and that then drives the extent to which we take a percentage of daily sales. So we can take anything from 2% on the lower, sort of smaller end of the spectrum, up to 20% of a merchant sales, but everything is driven by our assessment of affordability. So it serves nobody's best interest for us to be collecting too much from the business, because if you put that business out of business, then you are dealing with a credit loss. The PSP is possibly one customer short as well, and that impacts the livelihoods of the entrepreneurs who are putting food on the table for their families. So it's an affordability-based metric.
So I think Mohammed had a question. The mic is behind you.
Thank you, everyone, for the presentations. Maybe to Jonathan again, but feel free, anyone, to contribute. You mentioned the benefit of open banking. Could you just, and you spoke very briefly.
Yes.
So do you think this problem that Dominic has addressed in, say, a few years' time, we would be able to mitigate it or partially mitigate it by having access to other bank accounts that they have opened, to other point of sale points that they've opened?
So, I mean, that is possibly where I sit right now, one of the best ways to solve for that problem. And it comes into the whole adverse selection discussion and this idea of asymmetrical information. So in an ideal world, in a perfect world, we'd have sight of all their point of sale devices and all bank accounts. Unfortunately, that's not always the case, right? So what we can do with open banking is, and just to take half a step back, the underwriting decision that's based on revenue data it's an analysis of the line-by-line transaction data going through a physical point of sale or an online terminal. It's revenue based. It's not necessarily looking at the other inflows of the business, and it's certainly not looking at outflows. And so that's where open banking is so valuable, because you get a more holistic view of the business. Interestingly, to your point, we have sometimes flagged the need to request from a customer an open banking connection to a secondary account, because the underwriting team has seen transfers from the account that we have sight of into that other account and back in. So again, we don't have perfect information, and sometimes we're burnt by it, but it's an ongoing battle, and I agree with you. In the coming years, if we can have improved access, it will certainly help lenders.
I have a question, Damilola, for you from online.
Okay.
It contains an acronym that I don't understand, so I hope that you do. Okay, so it's about whether Moniepoint collaborates with VSLAs or cooperatives in Nigeria, if you were going to try and, like, say, go into rural areas where I presume these cooperatives are more important.
I don't know what the acronym.
You don't either.
What? Oh, okay. Village. Okay. So, okay, I need to be a tech.
Everybody else knew it, so
I'm sorry. I'm coming from a tech background, so you forgive me. So, yeah. So we actually had, before this current product we're running now, we actually had a model we ran as before this one, where we tried to, partner with, VSLAs, as you said, right? And it is extremely, it's kind of a touchy topic, because when you want to partner with them, it means you are leaving your credit risk in their hands, right? And essentially partnering with them means maybe you need to give them some kind of incentive to lend to them. But to a very reasonable extent, to a very large extent, sorry, your risk is controlled by how invested they are in getting your funds for you. So currently, the current model we actually run doesn't, depend on them directly, though we depend on them sometimes indirectly. So because it depends on the different areas, in the rural areas, as you've said, you need to involve the leaders of these associations or the leaders of these communities. Maybe when you have people that default on your loans, for some areas you literally can't go in to get your loans. That's when it goes bad. You can't go in there to take your loans without the knowledge of these people. So yes, we have to interact with them, but not necessarily on a direct partnership level right now.
Okay, and I have another question for you, which is, some of the rationale for more flexible finance is that it allows entrepreneurs to maybe undertake larger lump sum, riskier investments that are going to take a long time to pay back, and therefore it's more kind of conducive to financing growth. But is that what Moniepoint, is that the kind of thing that your clients are doing, or is it more about day-to-day cash flow, working capital management, the advantages of having a revenue-based contract from their point of view? What do you think it does for your clients?
So, sadly, on our side, our current model doesn't use a flexible repayment as is right now. So what we do is we give people loans with a fixed, repayment schedule. That's upfront. We tell you that you need to pay this certain amount at this day. But of course, depending on the size of the merchant, you have the capabilities or the capacities to, to be more flexible as respect to the repayment patterns. But generally, we actually have specific schedules that you have to pay for. So you have to pay this amount at this date, and at this date.
More questions from
yeah, I have a question, actually two questions. One about the open banking. We didn't speak about credit bureaus, typically in South Africa, etc. do you have access to credit bureau, and how do you use it as an alternate, as a complementary a source of information? And the second question is more relates to the last discussion we just had here with Damilola. Do you confirm that the revenue, I mean, what we're talking about in terms of revenue-based lending is more on very short-term working capital and would not really, I mean, except what was discussed, I think, in the first or second panel this morning, where we were on asset-based, I mean, digital collateral. But here, when it's completely uncollateralized, just based on the transactions, do we confirm that it's really fit for just a few months working capital loans, or do you see it as targeting longer durations or purposes?
So I'll pick up on the question about the bureaus first, and I'll speak to the principals. So we could typically pull two types of credit reports. One is on the business, and then one is on the individual or the consumer. And when you're looking at a small business or an SME, you're ultimately backing the jockey, and that contradicts in part what I was saying about how we make our lending decisions using data. But at the end of the day, the data can only tell you so much, and then it comes down to the jockey and the person running the business. And excuse me, the business report, in our experience in the UK market and the South African market, the business credit report fails to get into the weeds of the owner's credit profile, right? And so that's why we have a preference towards looking at the individual or the consumer credit profile. But getting access to that has certain reporting requirements where you need to feed information back into the scheme as a lender. And so they've only recently achieved that in the South African business. That was bought by a bank about 18 months ago, so they've got a broader data set to access, and they've got more tools at their disposal. We are actually, as we speak, looking to join a scheme here in the UK so we can get a more insightful report on the individual. The one thing I will say about credit reports is that we do sometimes struggle to attach the relevance or the recency of that to the actual performance or state of the business, because a lot of the time they're pulling information from, let's say in the UK, from the company's house, which is filed accounts that were filed 6 months ago for the financial period that was 3 months prior to that. So there's a 9-month gap, and we're looking at revenue from this morning when making our decisions. So there's certainly a place for credit bureaus and credit reports, but it's not what we primarily use to make our decisions.
Over here.
I think there's a second question.
Is there one over there still?
Well, was there a second half of the question that anybody wanted to pick up, which was about the use of funds or duration? Yeah.
Okay. So on the side of Moniepoint, as on part of Moniepoint, the kinds of facilities we offer to our customers are actually product we have running right now is a working capital product, which means we try to lend to you based on, what we are lending to you for is for you to increase your business capacity, like for business expansions. So for your business expansion, so maybe you are into oil and gas, you have a single tank for gas or for petrol or whatnot, or for diesel. We want to finance you to be able to, purchase the second one, or to be able to purchase more stock for your business, right? So if we want to lend to you, we need to lend to you based on data. I think we already mentioned that. So right now, what we do is we lend to people actually on shorter terms. So that's on 3 months, 6 months, thereabouts. And for people we need to extend something larger to, I think the maximum loans we give out right now are 1-year loans, which are 12 months. For us to go further, we need to have more data on you, because eventually, it's the data that tells us what kind of person you are. Just to piggyback on what he said, which is, you want to lend to or how we lend to a person is based on what we perceive their behavior to be. So, it's a lot better if we have some credit history on you. We can see that you've taken funds here, and you've paid back. That is, a testament to what kind of person you are, what kind of behavior you are. That's how you behave with respect to repayments. And if we've checked your credit history, we see that maybe you took money here, you didn't pay back. Irrespective of how your business is doing now, there is a chance that you take our money and just decide not to pay us. So for us to lend to you over a longer period of time, we need to actually, look at a longer period of data. I don't know if that answers you.
Okay, we had a question from Tim.
So this is a general question about thinking about optimal regulation from a societal standpoint on some of these things. So there's a great book called The Ordinal Society that is sort of pointing out that we're headed towards a place where we can be incredibly economically efficient in extracting the last bit of surplus with lots and lots of data. Where is that exact point where we extract all of the profit, but not so much of the profit that the business goes out of business? But of course, that's societally suboptimal. So in terms of the paper, I'd love to see something that's thinking through, what is the difference between the economically efficient version of these contracts and the societally efficient version of these contracts? For our two practitioners, then there is the question of, open banking is great until it enables the types of lenders who we know exist in the world who have no compunction about putting that borrower out of business as long as they get paid first. So, how do you think about in these developing markets regulatory capacity that enables you to continue to exist with regulatory function that prevents the bad actors from doing those sorts of things and using these tools that can be good for evil?
Can I go first? Is that right?
Yeah.
So I just want to touch on that regulatory point because it's one I actually put it down in my notes as something to touch on. So, and again, I'm going to compare the South African context to the UK context. So in both markets, our product is an unregulated product. Right? So there's slight nuances or differences between the South African environments and the UK, but for purpose of this discussion, you can assume that it's not regulated credit. The South African business is now about 13 or 14 years old. And what they did in the early days is they identified this as an unregulated space, which of course presents opportunities, but there are also risks. And as you said, the risk is that you put people out of business. Retail Capital in South Africa was a founding member of the South African SME Finance Association, which is a self-regulating body, and everybody plays by a common set of rules. And one example of those rules is when analyzing a potential borrower and you're looking at a bank statement or some other data point that points towards a competitor or another or similar type of funding in that business, you can't actually proceed with the contract until such time that it's been settled out. And so right there, you're catching a lot of what would have been over-indebting potential borrowers. Quite interestingly, in the UK context, the role of the association is actually not as active in my experience. We've only been here for about 1.5 years, but we're seeing a lot more stacking and a lot more piling in here in the UK than we do in South Africa.
We've got to wrap this one up, but I would like to ask Dominic a question, and I hope it's not an unfair one. It is you do all this, you spend all this time working with the revenue-based lender that you did your research with. So after you've finished your work and you've written up the paper, what does the bank or the lender make of it? And what was their reaction to what you found? And did they look at your work and go, "Oh right, well we better, we better do something differently"?
Yeah, I think so. Many of the ideas in the paper come from sort of continuously having conversations with the business itself. So, finding things, thinking, talking to them, getting their thoughts on that. And so I think this idea that businesses take other, get another sort of payment processor and use that to hide revenue is something that they were sort of aware of, and we helped sort of measure that. And they're thinking about different ways to mitigate that. I think another thing they're thinking about more too is sort of using all of this platform information that they have. That was something they weren't really using to underwrite in the past, and so that's something that could be used in the future. But they're great people to work with, and it was really exciting to work with them. And I think it was definitely like a sort of a collaborative effort going back and forth the whole time. So I really appreciated that.
Right. Well, thank you very much for joining us, Dominic. I know it was rather last minute, and thank you to our discussants. That's been great. Let's have a clap.